Welcome back to the Fostering Financial Victories podcast. My name is Eric Mazzell. I'm your co-host here with Bree Prosser. Today we are joined by another team member of Foster Victor, Smith Webster. So Bree, give everybody a little bit of background around what we are going to dive into. Hopefully you don't turn this off when you hear that we're talking about taxes.
So Smith is our tax expert around the office. He kind of helps all of our clients with guidance on that. So tell us a little bit about what you do for the Foster Victor team a little bit more specifically.
Sure. And thank you for having me today. I really appreciate the invite. So I like to say my role is kind of a three-prong role. I started out as a two-prong, but the third is kind of developed along the way now. So first thing I do is sit in with the advisory teams, working with our clients on mainly the carving out the tax planning piece of their financial plan. The second is, building out a network of CPAs, and then helping our clients when they have situations where they need to engage a CPA, really trying to refer them out to CPAs that are within our network and that we, work closely with. And then the third, this kind of developed along the way, is really education piece, keeping our clients informed of tax law changes, and also keeping the internally the advisory team and planning team and everybody really up to speed on tax law changes and just trying to educate from a tax perspective.
You make taxes more interesting, I would say.
Well, that's good to hear.
You have the greatest beard in the office. There's no doubt about that. All right. So, Smith, I think the biggest question we always get from clients is, hey, well, you guys do my taxes now that you have a CPA on staff. Can you talk through a little bit of that and kind of how we've tried to keep that a little separate?
Yeah, so I do not do taxes, just to answer that question up front. We are, really want to enhance the tax planning component of our financial planning process. So, getting to a point where the clients understand things and really can go out and then engage with their CPA is the main goal there. We want to help make that process as smooth as possible. We also want to, help if they have questions along the way in order to just get in front of any issues that may come up for them, and then make that process as smooth as possible.
Cool. All right. So total disclaimer. I know we have one at the end of this. This is not tax advice. Okay. So please don't take this for your specific situation. But what we want to talk about is kind of the value that a CPA can bring. So you've been a CPA for how long?
In public practice for 8 years.
Okay. So 8 years into this, and you've now transitioned into basically a totally different realm of CPA practicing. So for an individual taxpayer, as they are getting into that tax time, starting to prepare for filing and whatnot, the question always comes up is, do I need a CPA or can I do this on my own? What are your thoughts there?
Yeah, it's a great question. I think, unfortunately, you can no longer, as an individual taxpayer, deduct tax preparation fees. That's something that went away with the Tax Cuts and Jobs Act. So it always becomes a cost-benefit analysis. Are you going to get some benefit out of whatever fee you pay? There's a lot of different ways to look at that.
So from a procrastinator's perspective, me speaking to myself, those who wait to the end of the time for tax filing, they may want to have a CPA do it, but they may be forced to kind of go and do it themselves because everybody's, already slammed and too busy. So, from a decision-making perspective, as they're starting to think early on in the year, maybe it's right now, do they start the process of what do they start doing today to think, if I'm going to use a CPA in the spring, what do I need to be thinking about?
Sorry,
I stumped him again. Okay.
You're good. That's what editing's for.
All right. All good. John, I'm on fire today. All right. So, Smith, what should clients look for when it comes down to whether they choose a CPA or whether they do this on their own?
If you're a W-2 taxpayer, you have some very limited inputs into your tax return. Let's say just a W-2 form, maybe a 1099 INT. You're probably going to be able to get away with doing the taxes on your own with the tax preparation software. Now, if you have some changes in your tax situation, or there are things that are outside of those easy inputs, in general, I think that you would want to look at starting to engage a CPA at that point.
So from basically a complex standpoint, it sounds like there's a mesh point where it seems to be more beneficial to not try to wing it on your own.
Sure. From a complex standpoint, I mean, really, and I'll be completely transparent here. The tax law is very complex. There's been a lot of changes over the last several years. I, as a licensed CPA, have to do 40 hours of continuing education every year in order to keep up with the licensing requirements. Even with that, I go above and beyond those hours, countless hours researching tax rules, researching tax laws, researching tax cases, tax court cases. I think that it's so complex that it's even hard for me to keep up with all of it. So the complexity is there regardless. It's always going to be there. But when you have just some limited inputs, if you're really comfortable, navigating government forms, reading through things, even reviewing your tax returns once you've prepared them, then I think you can get away with, just using tax software. It's not necessarily going to be as complex as, some other situations.
So what would be some scenarios to where it would behoove somebody to say, you know what, I'm going to hand this off. There's probably some things that I'm going to miss by doing it myself, whether it be on TurboTax or whomever.
Sure.
Is there anything that kind of pops up as a generality that says you might want to let someone do that?
I mean, we can run down the list.
Yeah.
Self-employed individuals, people with rental properties. Those are going to be some complex situations, and there are a lot of rules, especially with real estate, the passive loss limitation rules. Navigating those, you especially want to make sure with a real estate situation like that you are tracking your passive loss carryovers. Since those are limited, if you're not keeping track of those, you're not going to be able to utilize them when you go to sell that property in the future. So that's a scenario that I would say that someone definitely needs to engage a CPA.
Kind of worth the price of admission.
Absolutely.
Okay. What do you feel like a good CPA, like what kind of qualities do you think someone should look for?
So really some simple basic things. A CPA should obviously have a license that's in good standing.
It's probably a good start.
Good start.
Yeah.
So you can actually go and check up on that. The IRS maintains a database where you can go and look and see if somebody has registered as a paid tax preparer with the IRS. You can also go to the State Board of Accountancy and look up a licensee there. They should also publish disciplinary issues. So if there's ever been a disciplinary issue with a CPA, then you should be able to find that information on the state website.
Okay.
Another thing would be, I would say just, transparency with fees. That can lead to a point of contention in the future, I think, with your CPA relationship. If you have hidden fees and you're not sure what you're paying for, you're not sure on what you're getting for your cost, for tax planning, tax preparation. So I think transparency on the fees, contingent fees in a CPA relationship are typically not allowed. There's some extenuating circumstances there, but contingency fees, you should probably avoid those kind of situations.
So what does that actually mean?
Where like if we get an X, a large enough refund, then you're going to give us X dollars of that refund. Something like that.
Almost
That's
like a commission.
Not allowed. Yeah. Almost like a commission. So I think transparency of the fees, just being upfront with them about that. And then really one of the big things would be just aligning their experience and maybe a specialty that they have with your specific situation.
Okay. The one term that always comes up is from an audit perspective. So is it really worth worrying a whole lot about for a typical W-2 employee? I'm really concerned about if I take this deduction or whomever, is it auditable? Like, what do you see there? Is it really worth the hassle worrying about it?
Well, it's supposed to be completely random. So I think everybody has a fair enough chance of getting audited. That would be my official answer. I think that, in simple situations, there's not a lot of room for error. Okay. So, you probably would receive a notice, maybe with an adjustment on your taxes if something was incorrect on your return. But I don't see necessarily a big audit risk for someone who's W-2 with a few inputs into their tax return.
Is there one thing that people have a similarity or a commonality with that have been audited that you've seen? Like a deduction, like a certain type of deduction or a certain type of industry that they may be working in, or like, is there something similar?
Well, they're listed transactions with the IRS. So they publish that every year. These are ones that are going to be, more sensitive, more high risk from an audit perspective. One that we could mention in particular is like a conservation easement. So if you're involved with a syndicated conservation easement, maybe that syndication is going to get audited, but you also have to file some things along with your return that are going to say, hey, I'm claiming deductions from this syndicated conservation easement. That may alert you to, or kind of run up the flagpole that would say, here's a higher audit risk return.
Okay.
So would that be on your list of like, if you're looking to do this, maybe you need to look at a CPA versus a do-it-yourself situation?
Absolutely, yes, because there's a lot of risk with not filling out those forms properly. So you need to find a CPA who's actually familiar with filling out those forms and reporting that. So yeah, I absolutely need a CPA in that scenario.
So since we're talking about auditing, federal government just voted to expand the IRS pretty substantially. What are your thoughts on how that might look?
Well, they say that it's for the intention of auditing and looking at higher net worth individuals and then corporations and things like that. So from the face of it, it does not seem like it's going to impact sort of middle class to lower income families. So you have to take them at their word at this point that that's the intention of it. It certainly could, more people that they bring on, more manpower that they have at the IRS, then is certainly going to allow them to look into other areas and things that maybe they have deferred for several years just because they don't have the resources to be able to look into those things.
Okay. Getting a lot of different opinions from many different sides of the aisle, it seems. Okay, so pros and cons of doing your own taxes or having a CPA do them. Ready, set, go.
The pros list is going to be pretty short.
Okay.
You may save some money.
Okay.
On the preparation fees. And then you may be able to brag to your friends that you did your tax return. I don't know of any other real pros to doing it on your own. The cons, I mean, certainly, the fact that you may miss deductions and credits. You also are going to have lost time. Time is a big thing that goes into this. And I actually have a couple stats that I can share with you. Try to stump you guys on this.
Yeah.
Increased stress level. I mean, taxes are pretty stressful. I remember growing up, I could see my dad around tax time trying to do it on his own. And he was, both my parents were W-2 income employees. And he was always extremely stressed during tax time trying to prepare his own return. So increased stress level is a con. Going back to the time piece, though, the IRS, interestingly enough, actually publishes average times that it takes to prepare a tax return. They include in these averages preparation time, record keeping time. So you got to think all your bookkeeping and everything.
Yeah.
And then reporting and filing. So question for either one of you. On the Form 1040, which is going to be your individual tax returns, they break it down into non-business versus business. So the non-business is going to, you think just your Form 1040 and then maybe a few schedules that go along with it. The business is going to be Form 1040, maybe a Schedule C for somebody who's a sole proprietor, or Schedule E with rental real estate. So any guesses as to how much time the IRS says it should take you to have all your taxes complete for the non-business return?
So if you're doing it on your own?
Doing it, well, it's just, I think this encompasses if you engage someone, if you, do it on your own.
And this is what the IRS says versus what it actually takes, plus like mental breaks and like taking a water break.
Maybe that's all built in.
I'm going to let you take it because no idea.
Way to be non-committal. Way to go. I've actually filed my taxes a few times, and I can think back. It probably took me about 8 or 9 hours in total from start to finish. Now, the stress level was, I agree with you. It's a little bit unique because you don't do that every day, right? But I'd say that's probably on average. What's the actual?
Any guess from you?
She's no clue.
Not
no
okay.
clue.
Not even going to try? All
No.
right, it's 9 hours.
Was it really?
That was it.
How about that?
Good job.
So I'm average.
Yeah.
Great. Wonderful.
And then the business side.
So this is plus the personal?
So yes, it's 1040 with your Schedule C
All right.
or your Schedule
So
E.
we're at 9 hours. I'm going to add another 5.
Almost there. It's 22 hours.
Okay. Still not guessing.
No, still not guessing. All right, well, I've got a little bit more for you.
Okay.
So if we're talking about corporations, S corporations, partnerships. So you're thinking Form 1065 for the partnership, 1120S for the S corp, and 1120 for the C corp. Now this ranges very widely.
Do I get to call a friend on these numbers?
Sure.
I have no idea.
So this is going to be a very small business in a very large business. This is a wide range, but these are separate returns. So flow through type returns, which would be the partnership and the S corp. Those you're going to get a Schedule K1 from that return, and then it flows through on your individual returns. So these are completely separate returns from the 1040. So
how much time on that one?
I'm not going to make you guess because it's all over the map. So it's between 75 hours on the low end for a small business and 895 hours on the large end. That's really going to be a really big, corporation.
That's a lot of time.
It is a lot of time.
Yeah. That's a lot of time.
But we do have a lot of clients that, own businesses that have S corps or partnerships.
Sure.
So there's a big burden on them to come up with that time. If they're running the business, they don't necessarily want to spend time doing their tax work.
Okay. So since you bring up the time component from a cost perspective, I think that's probably where a lot of people make that decision. Is it worth me spending however much it costs to get a CPA to do it, or can I just do it on my own? What do you feel like is an average cost for tax preparation for an individual, not business owner? It's a W-2 employee.
I think that's for a W-2 employee. It's kind of hard to say. I mean, it's all over the place. I mean, you have CPAs that work at bigger firms. So you're going to have somebody at the bigger firm that's preparing the return, and maybe a manager that's reviewing the return, and then you're going to get a partner level return. That's going to be more expensive than just having somebody who's a CPA on their own that, would maybe charge a minimum fee, maybe $200 or $300 to prepare the return.
Okay. So this is not on your list of questions, by the way. So let's talk through the dynamic with like what capacity CPAs would work in, whether that is them just filing taxes or whether that's now they're sitting down and doing tax planning, because there's a big difference. So can you talk through kind of how that might look from a different engagement standpoint?
Sure. Yeah. The tax planning piece is much more proactive. Your filing is just going to be, once every year, compiling all the information that you have from the year. Tax planning is going to be sitting down and looking at your tax situation, trying to figure out if there are changes that are coming up within your tax situation, things that you can take advantage of. Maybe you're inheriting some money, maybe you have an inherited IRA or something like that you need to plan around, the distribution rules that come along with an inherited IRA. Just a lot of different things. If you're selling a property, things like that. I mean, those are all factors that come into the planning phase of this. Typically the CPAs start planning around October or November of the year before the filing season ends. So that's kind of the timeline of the planning. And then, that's going to be a separate engagement from your tax preparation. So typically you're going to get another fee that's just for the tax planning, that's separate from the actual preparation. So that's something that people should expect when they're going in to engage a CPA. So
with that being in mind, do most CPAs just charge a flat rate? Do they charge it by the hour? How do they do it?
It depends. It varies by CPA. Okay. It is hourly or fixed fee. Typically for a planning engagement, I would expect more of the hourly rate. And then probably for a preparation, maybe a fixed fee, unless there's something that wasn't, known about when they went into preparation and there's additional work that has to go into preparing the return, then maybe it becomes an hourly rate. It's out of the scope of what you originally agreed to with the CPA.
Okay. Is it beneficial for someone who has been filing their taxes individually so let's say they're going to work with a CPA this coming tax year. Is it beneficial for them to have that person look back at previous year's filings to make sure that it was done in the best way?
Absolutely. And one example of that, we talked about the real estate earlier, in some of those passive losses that could be limited. You want to make sure that those are carried forward properly. So CPA should be going back and looking at their return, making sure that you're not missing any of those from a carry forward perspective. because then, like we said earlier, once you go to sell a property, you may have had all those passive losses limited along the way. Well, you can actually take those when you sell the property.
So how far back can someone go to have their quote unquote tax forms audited, basically, by the CPA?
Yeah, 3 years in general. Yeah, would be the statute of limitations, unless there's gross misrepresentations on the return. Then the IRS typically is not going to go back more than 3 years. So from a starting perspective, if you're engaging a new CPA, they generally would ask for 3 to 5 years of tax returns. Maybe they go back further and look in previous years if there are some real estate holdings or something like that where you want to make sure that you're actually looking at all those passive losses.
And the hope would be that they're going to save you or find you more money than what they're going to charge you.
Absolutely.
Right?
That's the end goal.
You might not be in the greatest position.
Right.
Okay.
But to that point, I mean, we're talking about the W-2 wage earners.
Yeah.
There aren't as many opportunities in that scenario for a CPA to go back and find things. It's just not part of their tax situation.
Okay. So you mentioned that tax planning or tax prep fees are no longer deductible. Is there anything else that people should know about, but maybe kind of flew under the radar like that? And if it's not, that's okay. But
I think that the most recent thing that we've run into is with the inherited IRAs and the complicated rules that are around those. In general, with a spouse inherits the IRA, then they have the rest of their life to distribute the IRA once they reach that required minimum distribution age. If you're, a child and a beneficiary and inheriting that, then you have 10 years to distribute the account. If the original owner of the account was after the required minimum distribution age of 72, then you may have an RMD requirement that you have to complete within those 10 years.
Okay. So Smith, we're going to kind of stop the tax talk. There are a couple questions that have always been asked to every guest on this show. You probably have heard these questions a few times.
Yes.
So guess what? I'm not asking those.
No, I prepared my answers too.
I bet you did. I see what you brought. Okay. So actually, I do want to know, what's the last 2 things you spent money on?
So my daughter's birthday party, we went to a ropes course in like a zipline park.
Yep.
So I paid for the birthday party there. And then my wife drives a minivan, has a lot of...
Does it have flames on the side?
No flames. That's a good idea, though.
It is.
I'm just going to put that on the side of the van when she shows up in the driveway. But it has a lot of like electronics and sliding doors and everything. The battery kept dying on it. So I went to the store and I said, give me the biggest battery you have. And that's one of the last things I spent money on.
Super exciting.
Yeah,
right there.
it's very exciting.
Yes. You could have put a super stereo system in there or something.
No, I'm getting the decals, the flame decals.
All right. So the other question I had for you, is there a favorite podcast that you're listening to right now? Or
For All Mankind.
Okay, For All Mankind. What is that?
It's a show on Apple TV. It's about space exploration, kind of my nerdy side coming out besides the tax stuff. So they have a show recap, and I like to listen into that. But I also listen to the Foster Victor podcast as well.
That's a good answer right there. Yeah. Is there anything that you've read in the last 3 months that you feel like people need to know about?
I mean, we've been reading about the Inflation Reduction Act. That doesn't really have...
Nobody's going to go read the Inflation Reduction Act.
It doesn't really have on the face of it anything to be concerned about. But recently, been doing some reading on the inherited IRA issue. So I think that's one that's pretty big that people need to be aware of.
Cool.
And there are some proposed changes, which we may receive a final ruling at the end of the year to kind of clear up some misconceptions with the rules, misinterpretations of the rules.
Awesome. All right. Good.
Okay.
And the one other thing, Secure Act 2.0 may actually push the RMD age back from 72 to 75. So we're kind of still waiting on that as well.
So you just brought up another acronym, the RMD. Tell everybody what that is.
The required minimum distribution. So when you have a qualified retirement account, you've deferred taxes out on that account. As long as you've been saving into it, eventually the government wants to get their money. So they're going to require you to start taking money out, and then it's going to be taxed at ordinary tax rates.
That'd be good if they push that back a little bit.
It would be good.
Yeah.
It would definitely open up some planning opportunities for us.
Yep. Cool. Where are you going to take us out?
Sure. So thanks so much for spending some time with us, Smith. Thank you for making the long trek from Foster Victor to be with us. If you have any questions, topic suggestions, or things you want us to cover, you can find us at fostervictor.com. Follow us on Instagram at Foster Victor Wealth Advisors. Share this with a friend, subscribe, download, and let us know what you think.
Information contained in this podcast was intended for general use, not to be used as specific advice. For content tailored to your personal situation, please contact one of our wealth coaches.